Hey, this is Jordan, and this video is being recorded on Thursday, December 2nd, 2021. Thank you so much for joining me today. Please like, comment, and subscribe if you are watching this on YouTube. And in today's video, I'm going to talk about the macro market picture and why the broader trend with respect to hard assets and bonds is shifting into 2022 and why I think this new trend will last for much of 2022. So, to start things out, we have a chart of the US dollar, the gold silver ratio in the middle, and the 10-year yield at the bottom. And the first two, the dollar and the gold silver ratio, those are above their 200-day moving averages. So, those are in uptrends. The US dollar is in a stronger uptrend than the gold silver ratio, but the gold silver ratio nonetheless still looks good. Looks like it's going to continue to rise. And if we look at the 10-year yield, and that's a big theme here of this video, is that we're going to see we may be seeing the start of a big rally in bonds to start 2022. And if you look at the 10-year yield, that is starting to fall below its 200-day moving average. It made a lower high. So bonds moving up in price means that yields will move lower. And when the dollar and the gold silver ratio are rising, you tend to see the yields, bond yields, at least the 10-year yield in this picture, decline if we look at the history over the last several years. And so I'm going to go through some of these charts quickly, but this is a chart from @MacroOps on Twitter. Great follow. And this is the short interest in bonds. And I think this chart is a few weeks or a month old, but you can see that the recent short interest, I think in TLT, is basically that is at over a decade high. So that's really significant negative sentiment on bonds. And we can see that the last time sentiment, it was in 2013, sentiment got pretty bearish. Bonds were already declining. They continued to decline. And another important thing to mention, when the Fed tapered, they started to taper at the very end of 2013. That is when bonds began a huge rally into 2014 and yields declined. So that's another thing to keep in mind. So the sentiment is very bearish on bonds. And this chart, I mean, this is from October, so it's over 1 month old, but it goes back 20 years, and I love charts that go back far enough. I mean, if you only go back 2 or 3 or 5 years, that's not far enough. You have to go back past multiple market cycles to see how significant something really is. And we can see it here, that according to the Merrill Lynch Global Fund Manager Survey, a net percentage of managers that are overweight bonds, or we could say that are underweight bonds, to make it easier. I mean, it's close to 90%. So global fund managers, nobody owns bonds. They're all underweight bonds. And I mean, this chart, the last one, really reflects that. So, and we're starting to see better performance out of bonds in recent weeks. So I'm confident in making this call that that's going to continue. The inflation trade, I mean, it's been all the rage. It's over for the time being. More evidence of that I will get to. And normally I don't include charts from other people, but this is from All-Star Charts, JC Peretz. They are really good at technical analysis in what they do. They really do excellent work. And this is a petrocurrency index that they made. And you can see this has kind of been a leading indicator for the price of oil. And the petrocurrency index in blue, you can see it made a positive divergence in early 2020 around the COVID low. Made another positive divergence, the first decline after that rally got going. And recently, it's had a pretty strong negative divergence. So that's, and we've seen a big decline in oil recently. It's put in a nasty candle on the monthly chart, which we can get to here. There you can see, I mean, that type of candle on a monthly chart, that's really nasty. I mean, the odds of oil making a higher high anytime soon are really, really low. And so here we have, this is a monthly chart. We have groups of commodities. So we have the precious metals index. I think it's a Goldman Sachs index. We have the industrial metals index, and then we have oil. And you can see the metals. They're basically trading around 10-year highs. So they have hit major resistance. The industrial metals. I mean, they already came up to that resistance earlier this year. They haven't been able to break through. That's not surprising. I mean, the precious metals they've already been correcting, for well over a year. And if you look at a continuous commodity index, I was trying to find a chart of that, but it looks very similar to the metals, and that's just a balanced or equal way to look at commodities. I mean, they've basically rallied up to this decade resistance, and they're going to pull back. They're not going to break out anytime soon. A very big picture, if we're looking out 2 or 3 years, they're probably going to make a huge breakout. It's going to be a huge money-making opportunity in commodities. But right now, the charts are telling us that commodities are likely to, at best, go sideways or correct. Gold's a leading indicator. Gold's been correcting. It was the first commodity to turn around, the first one to correct. For the rest of the commodities, they're going to follow gold as far as this correction. And gold's almost done with its correction. Maybe a couple months or 6 months left. But so you see oil there at the bottom, and I used a 12-month moving average because we know that inflation, the statistics are based on that. And so, any just sizable correction or weakness in oil this year, that's more evidence that all these worries about inflation are going to calm down. The market is already telling you, inflation is likely to come down this year. We're not seeing commodities make new highs. Bonds have started to rally. The sentiment in bonds is horrific, which is giving you the path to a sustained rebound in bonds in lower yields. So the inflation trade, it's over. It's done with. And, that is definitely, with respect to gold and silver, that's bad for silver, which I've been avoiding silver for a while. I'll talk more about that in future videos, but silver is probably going to continue to correct. Now, what does this mean for gold and gold stocks? Well, let's focus on the two catalysts that we could have: a significant stock market correction and the Fed hiking rates. Now, the issue with the Fed hiking rates is it depends really how strong the rally in bonds is, and if economic data really starts to fall off, then you could have the Fed push out that rate hike until late in the year, like what happened in 2015. We ended up hiking at the tail end of 2015 because the market, I believe, started to correct in early 2015. So that is something to keep in mind. Obviously, if the expectations for a rate hike don't change, even if bonds are rallying, that's a good thing for me as a precious metals investor, because we know the Fed hiking is a huge catalyst. So the sooner that happens, the better. Now, however, if the Fed has to push out that rate hike, if the market prices it in, now it's priced in for May or June. If that moves all the way to the end of the year, that's probably going to be an issue for the stock market, and we could see stock market weakness, and then that could become the catalyst. So it could be both. It could be one of the two. I do think we're going to see, after this decline that we're having now is nasty, it's going to lead into a major bottom for gold. But it's going to take a little bit of time. I know, story of every video I ever do. I know, people are frustrated. I say the same thing. But, looking at this chart, we can see that, we have the S&P at the top. I showed the 3 corrections over the last 7 years. We have gold, GDX. And at the bottom, we have gold against the S&P 500. So that is now, in addition to watching the Fed funds futures, and if the market is, how they're pricing in the rate hike, if it's going to come sooner or later, watch that, as well as watch the gold and the S&P 500 ratio. They're at the bottom. Now we can see, look at how that ratio acted before it rallied nicely in favor of gold. And so I don't know, perhaps in the last several months, the ratio's been trying to bottom. It's been a little weak, but it hasn't been that weak. It's been trying to bottom. If you zoom in closely, maybe that's similar to what we've seen prior to those other three bottoms in the ratio. I'm going to do another video at some point. I do think the stock market is at risk of having a significant correction next year. We're seeing more signs of that. Okay, so that's all for this video. I hope you found it informative. Let me know what you think. Follow all my work at TheDailyGold.com. A lot of great stuff there, a lot of great free stuff. Consider subscribing. Thank you so much, and I look forward to publishing another video update for you guys in the days and weeks ahead.